Good afternoon, ladies and gentlemen. This is Robert Rayburn. It is April 7th of 2022, and we're certainly glad that everyone could join us this week. Definitely been a volatile week. So we had a really big up day on Monday, followed by two big down days, Tuesday and Wednesday, and a pretty stable flat day here on Thursday. But overall, we're seeing that bottoming process continue. So remember what we said. Bottoms are a process. They aren't just a straight V up to the upside. And when we look at the standard deviation price data, what we call Z-scores in terms of quant language, we still continue to see that a durable low was likely put in that mid-March time period, as well as that late February time period. So overall, we see those lows holding, and we do see increasing evidence that growth is starting the very beginnings of a leadership transition away from value. And so that's really what drove a lot of the underperformance over the last year. And that's what we're going to focus on this week, is the idea that growth leadership versus value might be making a comeback. We always say might because nothing's ever guaranteed, right? But we want to review the factors that determine whether value or growth represent leadership, and what are those factors saying today. In addition to that, we're going to do a performance review, understand the role of factor investing as we just talked about, and then of course, what are the factors that we expect to drive performance and alpha, or otherwise known as outperformance, in 2022. So in the very short term here, when we look at the short-term trading scores, we look at everything through what we call Z-scores. So Z-scores are just a mathematical way of describing standard deviations, or when certain asset prices are trading far above or below their traditional average. And so typically when things are far above, you want to sell, far below, you actually want to come in and buy. And what we see here is within the span of really 3 days, we saw a Z-score that went from 2 standard deviations to the plus side with growth versus value, down to almost -2 standard deviations, or -1 standard deviations in the form of -1.66. We see this kind of big change in 2 days, typically emblematic of more of a short-term squall versus something that's more durable in nature, right? So it's like kind of coming into the room and you get hit in the face. That's really what the Tuesday and Wednesday were all about. We already see the volatility market starting to subside, so I think that's a really good sign here. And some of the more elongated Z-scores are suggestive of the very initial inklings of a resumption of leadership by growth stocks versus value. Now, in terms of market positioning, when we look at the prime broker data, so prime brokers being like JP Morgan, State Street, et cetera, we focus on the JP Morgan book. They have some of the one of the bigger books as it relates to their hedge fund clientele. Overall, March was an extreme month of de-risking. So the Z-scores, in other words, the standard deviation of de-risking, in other words, the extreme selling nature that occurred in March was -3 standard deviations. Now, that is very, very rare. There's only two other moments really over the last 10 years that we saw that. That was in March of 2020 and in December of 2018. Both of those times were very emblematic of very, very attractive buy-in periods, what we call those attractive buy windows, and why we think March and April of this year, right now, is a very attractive buy window, not just so much for the market, but specifically for growth stocks over value. Now, what drove that? A lot of it was de-risking by hedge funds, and a lot of that's caused by risk management departments. So when their risk management departments knock them on the shoulder and say, listen, I get you might be positive over the next 3 months, but we've gone beyond our risk budget, so we have to start de-risking the book. And that causes the last bit of selling that exhausts the market to the downside before we get that reversal back up. And we kind of saw that here in the back end of March, first part of April. The last couple of days, a little bit of a deviation from that, but we don't think that'll be very long-lived. Now, in terms of the performance, obviously, as we start the year, that Q1 was ugly, down 19.8% after fees versus -4 for the market. That's very emblematic of growth stocks in general. So when we look at growth versus value, certainly all growth portfolios, I shouldn't say all, like in general, most growth portfolios across the market significantly underperformed. And that was caused by that rotation away from growth away from growth and toward value. And that underperformance by our strategy has really been concentrated in the last 12 months. So when we look at the 1-year performance of down 22% versus up 14, all of that started in February of 2021, and all of that is related to the rotation away from growth and toward old economy, slower growing value stocks. Now, if we look at since inception, though, what we can see is a lot of our clients are up 135% after fees, about a 30% outperformance since inception for the opportunity portfolio. And we know that it's generally been a style issue, because when we look at our blue chip portfolio, what we see here is since the start of the year, the blue chip portfolio is down only about 1%, right? So think about that. We got old economy stocks in this portfolio that are really characterized by dividend payments, dividend growth, quarter in, quarter out, and down only about 1%. Now, we did have a good energy weight in this portfolio, so that did help in terms of performance attribution. But when we look at 2021, up 14.7%, when energy weight in this portfolio is a little bit less than we probably would have liked. And then since inception, up 95.85%. So has not generated the performance that the opportunity has, but over the last year has significantly outperformed. So what caused this rotation? Quite simply, ladies and gentlemen, the economy accelerated. So more companies were able to grow earnings in the double digits. Versus in the slow growth years of 1 to 2% GDP growth, you might only have a handful of companies that are able to grow 10, 20% a year. What does that mean? I'm willing to pay more for those companies. And what happens when lots of companies can grow that much? Well, I'm willing to pay less for those companies that were previously trading at wider multiples. Now, we think that's going to reverse, and we're going to show you why. But the second factor was the inflation tsunami that hit. We talked about those 3 waves of inflation that we think are temporary in nature, but caused significantly high inflation, which drove interest rates up, which drive valuations for growth stocks down. Why? Because as inflation goes up, discounted cash flow, what that causes is that those discounted cash flow metrics start to get depressed. Why? Because we're using higher interest rates to value cash flows way out in the future, where most of the earnings for growth stocks take place. And then lastly, of course, the Fed begins to tighten monetary policy. All in simple language, ladies and gentlemen, high growth stocks that don't need a strong economy, they tend to do very well when we have about 1 to 3% GDP growth. Cheap stocks or old economy stocks that only grow during a very strong economy, such as 4, 5, 6%, or 7% GDP growth, they tend to outperform when we're getting a very strong acceleration in the economy. So the question then becomes is, what's next, right? How do we determine whether growth resumes leadership? So what we want to show here is really, this was February of last year. We see growth stocks really sold off, and then we saw that value started to take the leadership reins. And right now, over the very short term, though, we see that growth versus value is actually starting to stabilize. So I think that's really good news. We saw a low here, and then another retest of the low. So we're holding those lows. We're starting to see on the upside some more violent upside volatility days for growth versus value. We think that's a very good initial sign. So what's next? We know that the economy is beginning to slow. A lot of the projected growth rates have gone from 7% in Q4 all the way down to 1% in Q1. And really the consensus is somewhere between 1 and 3% for the remainder of 2022. So a sharp deceleration. Inflation, that rate of change of inflation is beginning to slow. We're going to show you some of the underlying factors driving that. And then interest rates are actually approaching some of their long-term trends at around 2.7%. That tends to be very strong resistance. If those first 2 factors of a slowing economy and slowing inflation do take place and are persistent, we should see interest rates start to back off those higher levels. So what are those factor and style projections for 2022? So right now, when we look at the data, what we see is that the economy is being characterized by slowing growth, a decelerating inflation rate, and peak interest rates. So under this setup, will growth or value outperform? In 2021, we saw growth stocks surrender leadership to value stocks. Why was that? We saw accelerating growth, rising inflation, and higher interest rates. If in 2022, we see decelerating growth, slowing inflation, and interest rates that start to drop, do you think that growth or value will outperform? Our best guess, based on our research, based on our analytics, is that value will actually surrender leadership back to growth, which is why we made that rotation at the beginning of the year. Obviously, our timing was off, but this is the factor matrix that we use. So we see accelerating growth, rising interest rates, and rising inflation. We rotate from growth to value. And we actually did attempt that last year. Our timing was off because of, as we made that rotation to value, we unfortunately got hit with the Delta variant. But as we started to see moderating growth, moderating inflation, and rates start to steady, if not fall, we see a rotation from value back to growth. Now, at any point in time, if we go negative growth, that's recession. And we want to raise cash, we want to buy bonds, and we want, if we're mandated to own stocks, we want to own some of those recession-proof stocks such as utilities or consumer staples. So what are some of these leading indicators of inflation? Oil's down 23% off its peak. Lumber down 40% off its peak. Wheat down 20%. Copper down 5%. Now, copper's been much steadier, which is a good sign for the economy. Wages over this period of time have actually decelerated over the last 3 months, so that's good. And when we look at the trucking index versus CPI, what we see is that trucking rates are actually starting to fall. And that tends to be a leading indicator, not just for trucking stocks, which we see here with the black line, but also overall inflation in this blue line. Overall, the trucking rates relative to utilities have been a good leading indicator for overall CPI rates 6 months looking forward when we look at this chart. And so now that we see trucking rates starting to fall, we do think that in addition to all the other pieces of evidence that we see that inflation is slowing, that inflation will indeed peak and start to slow down here in the next month to 3 months looking forward. Used car prices, we see the same thing here. Used car prices were the very first indicator that we saw that inflation was going to spike. Now we're starting to see a sharp drop off in used car prices. Again, another sign that inflation is starting to peak. We put all that together in terms of a quant model for forward-looking inflation data. What we see is that the JP Morgan quant inflation indicator is starting to roll over just as we've likely peaked in terms of inflation. And lastly, are we below the line? When we look at the jobs data, the weekly jobless claims data fell to 166,000, the lowest since 1968. I think that's important. Why? Because jobless claims tend to be a good forward-looking indicator for overall economic activity. And right now, quite frankly, we're seeing no signs of recession as it relates to the labor market, as it relates to consumer spending. We do see a slowdown in spending, but overall, that labor market is incredibly tight, and we see that in the jobless claims data. So what wins? What wins when growth is slowing, when inflation has peaked or decelerated, when we see that interest rates have started to peak out? What are the factors that have led and lagged historically 12 months looking forward? What scores the best from a historical standpoint are pure growth stocks and pure defensive stocks with the win ratio of around 60%. What scores last are value stocks, so pure value or cyclical value. So that would be like your consumer staples, utilities. On the cyclical side, that would be energy, that would be some of the material stocks, steel stocks, autos. These are the types of things that are more cyclical in nature. In other words, they need a very strong economy in order to generate high growth rates. And when you don't have those high growth rates, we see a sharp deceleration in overall growth in terms of earnings for those cyclical or value names because they're not secular. There's nothing durable. They are price takers, not price setters. And we want to invest in companies that are price setters. So bottom line, a lot of the factor rotations that hurt our performance over the last trailing 12 months, we're starting to see signs that that is going to reverse. And that should actually become a tailwind to alpha or forward-looking performance over the next 12 months. Hedge funds panic sold in March. That's a good contrarian sign as it relates to the next 6 to 12 months of performance. Slowing economic growth may portend slowing inflation and peak rates. What does that mean? That should be good for the pure growth style factors that historically lead performance in this type of economic environment. So overall, we like where things are setting up, actually. We think this is a massive buy window, very similar to March of 2020 and December of 2018. We don't think these moments come along very, very often. We're actually pretty excited when we talk about this stuff because we think that we finally hit that window and we like where things are going here. So if anyone has any questions or concerns, please feel free to reach out to your advisor, our home office. We'd be more than happy to help. So otherwise, have a fantastic evening, have a great weekend, and we'll speak again next week.